Imagine this, $10,000 invested in the S&P 500 at the beginning of 1965 would have grown to a staggering $2.7 million today, assuming you reinvested the dividends. Doesn't this sound like an incredible opportunity? So, why isn't everyone a millionaire by now? The answer is surprisingly simple. Most people didn't invest their money this way. By now, most of you are likely familiar with the S&P 500 index, but in case you're not, let me provide a quick overview. The S&P 500 is a market capitalization-weighted index comprising 500 of the largest publicly traded companies in the United States. It serves as the benchmark against which many investors measure their own performance. Over the past 30 years, the S&P 500 has delivered an average annual return of 7.5%, accounting for inflation. While this may seem like a respectable rate of return over a long-term period, many investors, especially newcomers, seek higher returns to build wealth more rapidly. This is particularly true for younger individuals who often have limited capital to invest. Consider this, earning a 7.5% return on $10,000 yields just $750 per year, whereas the same return on $1 million amounts to $75,000, a considerably more substantial sum. Given these circumstances, how can young investors get ahead financially?
Declare bankruptcy!
The answer seems straightforward. Aim for returns surpassing 7.5%. Why not make 20% or even 30%? While it may initially appear within reach, we often hear about those individuals who struck it rich with early Bitcoin investments, NFTs, GameStop, or by handpicking small-cap stocks that skyrocketed in no time. However, it's essential to recognize that these success stories represent a minority. The majority of people tend to invest in these assets after the significant growth has already occurred, essentially buying at the peak and selling when they can no longer withstand the losses. So, let's shift our focus away from these meme investors and consider the achievements of seasoned professionals on Wall Street who possess extensive experience and limitless resources to outperform the S&P 500's modest 7.5% annual return. This is where things get truly fascinating. Fidelity's Magellan Fund, managed by Peter Lynch from 1977 to 1990, achieved an impressive annualized return of 29.2% during that 13-year period, consistently more than doubling the performance of the S&P 500. The legendary investor Warren Buffett, renowned for his astute investment strategies, has averaged a remarkable 19.8% return from 1965 to 2022, compared to the S&P 500's 9.9% over the same period. Additionally, Renaissance Technology, employing complex statistical and probabilistic approaches with the brightest mathematical minds and cutting-edge computing power, has effortlessly surpassed the S&P 500 performance over the past decade. By highlighting the achievements of these accomplished investors, we can better understand the exceptional expertise, resources, and extensive research required to consistently outperform the S&P 500. Now that we have explored the potential for outperforming the S&P 500 and acknowledged its feasibility, you might question why settle for a 7.5% return when you could potentially earn much more and reach retirement sooner. However, let me bring you back to reality. If you compare yourself to investing legends like Peter Lynch, Warren Buffett, or Jim Simons from Renaissance Technology, you're setting yourself up for disappointment. These individuals possess years of experience, extensive teams, substantial capital for research and development, powerful computers, and vast analytical databases that would take a lifetime to navigate. As a new investor scrolling through Reddit in search of the next big breakout stock, your chances are slim. Without in-depth analysis of company financials, market research, and industry trends, it becomes nearly impossible to outperform the S&P 500 consistently. While you may experience occasional lucky wins, there will come a time when you'll face humbling losses, as witnessed in 2022 when even the most acclaimed financial gurus on YouTube suffered unimaginable setbacks on stocks they deemed inevitable home runs. Now, let's shift our focus from negativity and explore actionable steps that individual investors can take to maximize their earnings. While we cannot compete with financial institutions or companies equipped with substantial resources for research and development, we can adopt a simple yet proven approach that has delivered consistent results over the decades. Instead of wasting precious time attempting to select individual stocks that ultimately underperform the market in the long run, I strongly recommend adopting a strategy of dollar-cost averaging into large index funds. These funds, such as those tracking the S&P 500 or other international indices for added diversification, offer numerous benefits. They alleviate the stress of researching individual stocks and provide better, more consistent returns over the long term. Now, don't get me wrong, I understand the thrill of engaging in exciting investments and allocating funds to risky breakout stocks like GameStop or AMC. However, it's crucial to keep these speculative ventures to a small percentage of your overall investment portfolio. By doing so, even if you were to incur losses on such high-risk investments, it wouldn't have a significant financial impact on you. In conclusion, don't try to outsmart the market or compete with financial institutions. Keep it simple and focus on index funds like the S&P 500 for better, stress-free returns. Invest wisely and enjoy financial success. Be sure to subscribe to Wisdom Wave, where we explore the fascinating world of technology, careers, and business. Until next time, keep seeking wisdom and riding the waves of knowledge.